with Upstream Deferred Intercompany Inventory Profits and AAP. Assume that a parent company acquired 80% of the outstanding voting common stock of a subsidiary on January 1st, 2012. On the acquisition date, the identifiable net assets of the subsidiary had fair values that approximated the recorded book values except for a patent, which had a fair value of $100,000 and no recorded book value. On the date of acquisition, the patent had 5 years of remaining useful life, and the parent company amortizes its intangible assets using the straight-line amortization. During the year ended December 31st, 2013, the subsidiary recorded sales to the parent in the amount of $100,000. On these sales, the subsidiary recorded pre-consolidated gross profits equal to 25%. Approximately 30% of the merchandise remains in the parent's inventory at December 31st, 2013. The following summarized pre-consolidated financial statements are for the parent and subsidiary for the year ended December 31st, 2013. And then we have their income statement, retained earnings, and balance sheet. And the question is saying, based on this information, determine the balance for the consolidated net income attributable to the NCI. And so we can just put the basic formula in here, and then we'll find all the information to fill it in. So we're going to have the percentage of the NCI, and we're going to multiply that by the net income of our subsidiary minus the AAP amortization minus our upstream deferred profits on the intercompany sale. And so let's just go plug in our information. The percentage of the non-controlling interest is 20% because the parent has 80. So over here we'll put 20%. The net income of our subsidiary can be pulled from the income statement. So $160,000. And that's actually the only information that we have to pull out of the income statement, retained earnings, and balance sheet they gave us. So in a lot of ways, this is almost like a big red herring. Our AAP, it was $100,000 over 5 years. Oops. So it's going to be $20,000 annually. And then the upstream deferred profits on the intercompany sale was also $100,000. And then 25% gross profit, so times 0.25, and 30% remains in merchandise, so times 0.3 for $7,500. And now we can just plug all of this in. So that 20% times, open parentheses, the net income minus the AAP minus the upstream intercompany profits gives us $26,500.